Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to look at an energy company that has been rewarding dividend investors for 31 years. The stock is considered to be undervalued. This company has generated $1.1 billion of free cash flow in Q1 2023. Let's take a look to see if this is one that you might consider investing. Do me a favor, hit that like button, hit that subscribe. Don't forget to hit the notification bell. As always, this is not financial advice. Please do your research before investing. With that out of the way, let's take a look at this company. So the company I'm talking about is EOG Resources. The ticker symbol is EOG. For those of you that are not familiar with this company, it is a company that develops, produces, markets crude oil, natural gas, and natural gas liquids, formerly known as Enron Oil Gas Company. So if you look at their website, you can see areas of operation. You can see it's mostly in the middle. You got places in Denver, Oklahoma, Midtown, Houston, San Antonio. Then you got Eagle Ford, and then you got Trinidad and Tobago. So definitely go to the website, take a look at it if you're interested in maybe adding this into your portfolio. So if we go to their presentation, look at their Q1 2023 highlights, you can see outstanding first quarter results. You can see in here they generated 1.1 billion cash flow, further strengthening the balance sheet with 1.25 billion debt retirement, and then you can see they've returned 1.4 billion to shareholders in the first quarter. Now if we look a little bit more, you can see they're delivering on cash return commitments. You can see right here, sustainable dividend growth. They have a pristine balance sheet, as you can see, additional cash return, low cost property bolts on. And then if you look further, you can see 22% CAGR. So you can see from here, from 1999 to about 2023. And then if you look further, you can see some more balance sheets, the debt, financial leverage, and then the liquidity. Yeah. So let's take a look at the Simply Safe dividend. You can see their dividend safety score rated as 82, which is very safe. The dividend yield is about 3.09. Market cap is about 62 billion. You can look at the key metrics. During the recession, they have increased it. Forward payout ratio is 28, payout ratio is 25. And you can see right here, dividend streak of 31 years without a reduction. Looking at the dividend growth, you can see the last 20 years, 24%, and then the last 5 years, 36%. So if you invested in this company 20 years ago, you would have been up 24% per year. And then the last 5 was a little bit much more stronger, 36, and then you got 10%. I always like to see an upward trend. You can see here, 5 years of dividend growth, 31 years without a reduction. So, and then your payout, you get it quarterly in the months of January, April, July, and October. Your annual payout will be $3.30 per share, and then your ex-dividend date is July 14. 18 days away if you want to get into it before the ex-dividend date. Yeah. Looking down, you can see some of their special payouts. So they have all these special dividends that they give every now and then. And then you can see here, maybe undervalued. It is closer to their 52-week low right here. And then you can look at their free cash flow, sales growth, total sales, return on investment capital, return on equity. Now if we go over to Alpha Trends, you can see the fundamentals. You can see the revenue for the past 10 years has increased to 131%. Operational income, the net income, operation cash flow, you can see 10 years, and then your free cash flow of 10 years, and all that stuff. And then you can see the balance sheets right here. Assets of 41 billion versus the liabilities of 50 billion. Now if we go to bar chart, as you can see, based on their analysis, they're rated at a strong buy. It's been strong buy the past 3 months. Breaking it down, currently you can see 17 strong buy with 4 holds. Now if we go to Seeking Alpha, looking at the 10-year performance, you can see 77%. 5 years is about 0.6, and then you got your max, which is about 1,000%. Now if we go to Simply Wall Street, based on share price and fair value, they say it's about a 3% overvalue. Their fair value says about 103. Currently at the time of this video is about 106. And then if you look at the financial health, you can see right here, short term, their assets versus liabilities, and then you got your long term, and you got your assets over here of 31 billion versus your liabilities of 11 billion. Now if we go swing over to stock Rover, based on their analysis, they rated it as a strong buy. There's about 21 of them. 17 says strong buy, 4 says hold, no sell, no strong sell. And then if you look further, you can see a little bit more information. Now if we swing to TipRanks, you can see based on their analysis, they rated as a 38% upside, strong buy, 10 strong buy, 2 holds, and then their price forecast rated as a high of 167, an average of 147, and then a low of 130. Now if we go over to CNN Business, you can see based on their forecast, you see a similar one with a high of 167, a median 146, and then a low of 115, with the analysis recommendation of 25 buy, 7 holds, and then 3 outperform. Now swinging over to Webull, based on their analysis, they rated also as a buy. There are 32 of them. 31 says a strong buy, you got 18 as a hold, and 50% says a buy. Now their price target is pretty similar, 167, 142 would be the average, and then 109. So currently at the time of this video is 106. Now if we go to Yahoo Finance, what I wanted to see was compare it to the S&P 500. Based on the 5-year track, you can see EOG is this green one, and then the S&P 500 is that. So I see for the last 5 years, it has not performed better than the S&P 500. So that's something for you to kind of think about. Now if we go further, you can see a little bit more, some information for the 5-year mark. It's down 14%, and then for the year it's down 6%. Year to date it's down 14%. You know, that's pretty much it, man. My take on this, it's a great company, but if I were going to invest on it, I would rather invest on other companies such as Exxon or Chevron. They have the pretty much similar current price. So if I was going to go in that area, I would go to one of those instead. It is a solid company, but there's also other companies like those things. So definitely do your research. Hope you like this video. Give it a thumbs up. If you haven't done so, subscribe, and also do me a favor and check out the other videos as well. There's a lot of dividend companies that I've also researched. As always, please stay cool, keep investing, and I'll catch you guys in the next video. Right, take care. Aloha.